We got a question here. What's the cost of waiting? Great question.
Yeah.
I'm gonna stop sharing my screen so you can see Peter and me. Um, so typically when you wait on these strategies, one of the things that can happen is if you do your planning late in the year, you've already given money to the government through your estimated tax payments. So you've given up access to that capital. You now have to wait to receive it in a refund. If you fail to plan during the year, then obviously you're going to pay the government all this money. And while there are some strategies to go back and get refunds, they're not nearly as powerful as the proactive tax planning that you could do during and before the year ends.
Yeah. And I would say, as you can well imagine in the tax arena, if you don't pay a tax that you should pay, the government might charge you interest and penalties. If you pay more than you should have paid and you become entitled to a refund, they're not as generous. So that proactive planning is so important to, hang on to as many of your own dollars as you can and keep them hard at work for you.
Let's see. I think we got another one in the chat here. Uh, you hear often a CPA tell clients every year they did everything they can to reduce their taxes. So why does it feel like my CPA just wants to check the boxes? Do you have any insights as a third generation CPA? So I used to be in the tax preparation business. I joined my father's accounting firm when I graduated school with a degree in accounting. I became a certified public accountant and I did prepare tax returns for our clients at WealthThrive. We don't prepare tax returns. But what I found in that business was it wasn't profitable for us to spend more time with clients to develop strategies. And that's because most clients shop for their accountant based on price and quality and speed, but price is a big issue. And so when you're in the public accounting arena preparing tax returns, the way you build a profitable business is by figuring out how you can spend as little of time possible with the lowest level people to be able to satisfy the compliance requirements of that client. And so if you want additional planning, you have to pay for it as a separate fee. And even when that client would desire to pay for tax strategy under a separate planning engagement, the challenge there was it's the partner's time. It's the highest level person who, even if they're charging in today's market 500, 800, $1,000 an hour for their time, that's not as profitable as driving the work down through a team of people and generating leverage. So it's just not the business model for tax preparation firms to provide clients with unique strategies. And the other thing is that most accountants have a very different risk profile than their entrepreneurial clients. And so what we find is often when we make a recommendation to a client that their accountant has never heard of before, we get two different reactions. One is the rare case where the accountant's like, wow, this is amazing. I can't wait to introduce you to all my clients. And that does happen. I would say more often we get this wasn't built here. What I'm not up on, what I'm down on. And I would just tell you don't do this. And that comes typically from a place of ignorance more than education. And it's also not their pocketbook. So it's easier for the accountant to say no, similar to if any of you have a lot of deal experience. I mentioned I've done a lot of deals. And so typically lawyers are in that same category where it's much easier for the lawyer to say no because there's no liability in saying no than if they say yes. So uh, hopefully that's helpful. And another question, a donor advised fund, is that a good tax reduction strategy for business owners? Peter, you want to take that one?
Sure. What is a donor advised fund? So the main reason people use that, let's say you have five favorite charities and you want to make five charitable contributions to those charities, you can write individual checks to the charities. The donor advised fund is one charitable contribution to an entity, which then can make donations to the charities. So that initial contribution by the donor to the donor advised fund, that qualifies as a charitable deduction. Uh, so it's a simplifying tool Uh, and it comes into play a lot in the case where a client may have a large capital gain, but they may not want to give all the money to charity in the year that they have the gain, but they want to get the value of that donation. So they sell a building, they have $1 million capital gain, they could move the entire $1 million to the donor advised fund, subject to certain limitations. They would be qualified to take the deduction in that year. And then in that year or succeeding years, they could parcel out the money to their individual charities. It's nice administratively because if you work with any of the leading donor advised funds, they do all the paperwork. You write an email and say, please send, $10,000 to the following 10 charities. They do that. They keep the records. So it's a nice tool to use.
And one of the advantages of using a donor advised fund is often instead of writing a check to your donor advised fund, you contribute appreciated assets, typically appreciated stock. And as a result, you don't pay capital gains tax on the stock that you would have paid capital gains tax on if you sold it, and you still get 100% of the value of the deduction. As it pertains to today's conversation, you get a much better result
Right.
investing 125,000 and getting a $600,000 tax deduction than you would contributing 600,000 of appreciated stock to a donor advised fund. So the strategies would not be necessarily competing with one another. It would be for people that actually want to write checks to the causes they care about, and they want to come up with a more efficient way to do
Correct.
that. We did have another question about the difference between tax avoidance versus tax evasion. And I think this is a great point you bring up, because the question here is, many conservative lawyers and accountants approach the relationship of the taxpayer and the IRS, trying not to fall into that trap of tax evasion. So tax evasion can get you into criminal liability, not just financial penalties or interest on the problem. And of course, one of the things that we pride ourselves on is ensuring that all of the tax strategies we recommend, the worst case scenario for a taxpayer, if things go horribly wrong, is that you're likely to pay the taxes that you would have paid had you not participated in the strategy. So the outcome is typically no worse than having not done it. Because of the way that we structure things. So you want to be sure that you are doing things on the up and up, that you are taking advantage of the tax code, which there's a famous quote by Judge Hand that
Right.
says, every taxpayer has the obligation to pay only the amount of tax that's required and no more. And so the tax code is there for you to take advantage of.
I think he also said there are two tax codes in America, one for the informed, please work with us, or that tax code for the uninformed. So, and I think I often use the terminology of there are kind of three worlds of taxes. There's the black and white world. That's the world CPAs live in. There's a gray world, which is a lot of people don't appreciate. Not everything in the tax code is black and white. Not everything is laid out. And it's that grayness that creates opportunity that you can often take advantage of completely legally. The red zone is what Noah was just talking about. That's tax evasion, that's stripe pants material. We don't advocate any of that. But interestingly enough, in my view, the gray zone is the biggest zone of all. And there are lots of opportunities in each individual case to take advantage of that gray zone. That's what the Wealth Thrive program that I summarize briefly is all about, to help you take advantage of those opportunities.
And a follow-up question we got in is, are you suggesting a tax opinion letter to cover
Ah,
these strategies? And yes, this 60% AGI strategy that we covered today, not only is there a tax opinion letter available to any participant that wants it, but in addition, the strategy itself has $1 million audit defense fund for the master LLC. So if any of the series participants are audited, they will cover up to $1 million of fees to defend the taxpayer and defend the series. So, we have confidence that, as I mentioned, in the case that you have a dispute with the IRS, I'll walk you through kind of what happens. So,
Right.
the first thing that happens is you have to be selected for an audit. If you report over 10 million of income, which most of our clients do not do because of the planning we've done, but if you report over 10 million of income in 2023, you would have been audited 11% of the time. And the IRS has a goal for 2025 to audit 15% of taxpayers that report over 10 million of income. But if you report under 400,000 of income, which is, I would say, more likely for the clients that we work with because of the reduction strategies that we use, your probability of an audit is around 2%. So that means anywhere between a 90 to 98% chance there's no questions asked. In the unfortunate event that you're in the 2 to 10% where they are asking questions, the first thing they're going to do is send you a letter. That letter is going to say, please provide us with additional information about A, B, or C. And you can then do what's called a correspondence audit and reply to them. Now, in 20 to 30% of the cases, on average, those correspondence audits just end right there. You respond to them and they come back to you and say, okay, we're done. Thank you very much. Case closed. Well, obviously, in other cases, they ask for additional information. And in the worst case scenario, if you can't agree with the IRS on the amount of tax that you owe them, you would litigate with them and go to tax court. Now, 80% of cases settle with the IRS before litigation begins. And of the 20% that begin litigation, 90% of them settle during litigation. So very, very few taxpayer IRS disputes end in a judge's decision. So on almost all cases, you're going to settle with the IRS on something. Now, on average, we encourage our clients, depending on the strategy they're participating in, to reserve 20% of their tax savings as their audit settlement fund. Now, if they're not audited during the window, that audit settlement fund can go be used to buy themselves a new boat or, luxury vacation or use as you so choose. But until you pass your audit window, we encourage that tax savings amount to be invested in a separate account so that each and every year you can see how this tax strategy has added to your financial well-being. And we believe that that's a good way to measure your return on tax strategy, and that if and when the IRS comes knocking and you settle with them, you are likely to see that it's a small fraction of the amount that you saved over a number of years implementing new tax strategies. Do lawyers or dentists or other professions get audited more than common folks? I would say that the reason that perhaps lawyers or dentists could get audited more is the way their business is structured. Many of them report their income on Schedule C of Form 1040, their personal tax return, and Schedule C, which is the sole owner business information, that gets audited more often than separate tax returns for business partnerships like LLCs with multiple partners, or partnership returns, or C corporation returns. And so one of the strategies that we encourage clients to use if they have a single member LLC that they're reporting on Schedule C is to add a partner to that business, get it off of your personal return, and reduce your audit rate. Another question came in, what's the length of time of an audit window? So typically audits are going to look at your 3 prior years. So they have 3 years to audit you. In certain circumstances, they can go back 7 years for material misstatements. If you commit fraud, there is no time limit. So that if you commit fraud, your IRS can examine you 20 years back. And of course, as Peter referenced, all of the strategies that we're recommending are not fraudulent. They're taking advantage of an area of the tax code that we're utilizing and interpreting the law in a way that favors the taxpayer. We support that with a tax opinion letter, which is a letter written by a qualified third party that's examined all the tax code and writes in a clearly defined, step by step how this is compliant in a more likely than not basis. That's the standard for the tax opinion letter. And when you have a tax opinion letter, if the IRS were to audit you and disagree with you, the worst thing they could do is ask you for the taxes you would have paid had you not performed the strategy, plus interest from the date that you should have paid them to the date that you actually pay them, but they can't charge you a penalty.
And I think
Uh,
what's key there is in many cases, you would be able to earn more on your money than the interest that you might owe if it was determined that you owed the amount and the interest. So, opinion letter is valuable to knock out the penalty piece of it, but could still leave you in a plus position even with the interest.
Yeah, the interest is a reasonable rate. So, right now it's about 7%, but it was as low as, 4 and 5% when interest rates were lower. So if you've invested your capital in the stock market, and I use a story of a client who participated in a tax strategy in 2018. We knew at the time that that strategy was going to create an audit for the taxpayer, but they saved $4 million. And what we said at the time was you're probably going to have this audit, and in all likelihood, you'll settle with the IRS for somewhere between $800,000 to $1 million. So net, you'll be ahead $3 million plus dollars. Well, that was 2018. The audit was opened in 2021. The audit is still ongoing. That $4 million is now a bit over $11 million, and the probability is still the same that the if and when they settle that case, they'll pay somewhere between 800,000 and $1 million. So again, I think it goes on a risk reward perspective, which I think a lot of entrepreneurs are making risk reward based decisions in their companies all the time. And it's different than saying there's 100% chance that this is 100% going to work as advertised. There's always some chance that some auditor is not going to like what you did, and you're going to have to settle with them for some amount, or you're going to litigate with them and in the worst case scenario, litigate to a conclusion. But again, we believe in the probabilities are going to create a wonderful outcome, especially if you do this year after year. There's a question about S Corp K1. I'm not quite sure what it is, so feel free to maybe type a little bit more detail. And another question was, is there any reason not to get a tax opinion letter? I would say the only reason not to get an opinion letter is because you don't find the risk worth the cost of the tax opinion letter. The tax opinion letter, in some cases, it could cost $1,000, $2,000. In other cases, we had a client last year spend $250,000 for their tax opinion letter because they didn't want to work with an attorney that we work with that has done that for other clients that charge $10,000. He wanted the opinion from a white shoe Manhattan law firm that charged $2,400 an hour. And as a result, he got his $250,000 opinion letter, but it gave him the confidence to implement a strategy that saved him $15 million. Uh, Another question on the audit window. So the length of time is typically 3 years for any normal audit. It extends to 7 years for a material misstatement, and it could be unlimited in the event of fraud. Uh, okay, the S Corp K1 was a reference to the dentist and lawyers. So yeah, I would say typically any professional practice is not going to be audited at any higher rate than any other type of practice. What you see is the IRS typically using industry averages. And so if you have a business that spends much more on marketing than your peers based on your industry SIC code, which is included on your business tax return, the NAICS code, it's a code that's in your tax return. The government is using that code to benchmark your return and the items on your return to see what is your revenue, what were your cost of goods sold, what is your net income. If you're deviating significantly on those line items, that's one of the reasons that an audit may get triggered. Great. Well, if we don't have any other questions, we want to thank you for hanging with us. We hope you learned
Thank you.
something valuable. Of course, we'd love the opportunity to look at your individual situation to see how we might be able to help. We're really excited about this new 60% AGI reduction strategy using a leveraged charitable contribution. Again, it applies to W-2 income. That's totally new for us this year, not something we've had in the past. But we do have a plethora of other strategies that can make an even bigger impact and can reduce your taxes even further. So if you've got any other questions, I'll stick around for another one, but we're happy to wrap it here too.
Thank you, everyone.
Thank you. Oh, let's see. If you don't have W-2 income, that 60% AGI will apply to all income. So it'll apply to your capital gain income,
Right.
your ordinary income from businesses, from real estate, however it comes in. Now, remember, if you have a capital gain, your federal capital gains tax is 20%. Well, this particular strategy, if you invest 125,000, you had $1 million capital gain, you would have paid 200,000 in taxes. If now you invest 125,000 and reduce your income by 600, now you have to pay 80,000 in tax and you paid 125,000 for the investment. It didn't get you anywhere. So typically we want to use a strategy like this to offset ordinary income taxed in the highest brackets.
Yeah.
Yeah, if 120 is a W-2 and 800 is from an S corp, this strategy is going to work perfectly. It's going to offset all of your top tier income. In the examples, we applied the top tier tax rate across all of the income. In a practical application, we have progressive taxes, meaning that your first $100,000 of income is taxed at a lower rate than your second $100,000 of income, and that's taxed at a lower rate than your third $100,000 of income. So actually, when we reduce your taxes, we're actually reducing it at the highest rate first. So it's really a great strategy to reduce your income and push you into lower tax brackets. Excellent. Well, thanks again, everyone. We
Thanks,
appreciate
everybody.
your attention. We hope to see you again soon. Bye bye.
Thanks. Bye-bye.